Mate, Friday fun day, Friday fun, yay, or what do they call it? Friday, yay, mate, welcome along. Another Wine and Wisdom, my friend. We are live on Facebook right now, according to the technology, mate. So, yeah, awesome. Good to see you, brother.
Good to see you, mate. Been a good week?
Mate, been a bit of relaxing week this week. Took the foot off the pedal for a few days and sharpened the sword at my end. So doing a bit of a course, bit of a program, learning some things for me, mate. So yeah, I was sort of did a bit of a Facebook Live this week about investing in yourself, and I was adding it up. I reckon close to $1 million over the last 20 years of programs and courses and education for me and my beautiful, amazing wife, Shay. So, yeah, so far, getting excellent dividends from the investment. So, mate, what about you? How's your week, brother?
Well, mate, I haven't done the math on the old study, but if I was to put university in there, I'd shudder to think. I'd shudder to think.
Yeah, well, uni isn't cheap. That's one of my bugbears.
There'd certainly be a Lamborghini or two in it, I would imagine. Not that would be the car of choice, but no, mate. It's been an interesting week on our side of the equation. Obviously, second week back down into lockdown, so
yes,
we're slowly starting to turn into haters down here. No, just joking.
Mate. Well, no, it's interesting. Like I certainly I've got a team in Melbourne and clients and friends, obviously, and the vibe's pretty. It's somber, right? It's not, it's a bit sort of challenging. So any of the Victorians listening in, hope you're staying well and take care of yourself. We've got a few people dialed in. So Bradley, Vivian, Shay, my best fan, and Emily, Alex and Rod, good to see you guys already on tonight. So, awesome. For those who are dialing in for the first time, Andy and Jason Witten, Andy Fenton, we get together each Friday for a little bit of wine and do a bit of a debrief on our week. Our worlds are real estate and finance, and what we do is we just get to sort of debrief on what we've seen for the week. Started at the beginning of COVID and has continued on. We enjoy it, and hopefully you guys do too. We get to share some of the experiences that we've sort of learned as professionals in these industries for over 20 years. So welcome along for everyone dialing in tonight. We always sort of get ourselves warmed up and get a bit rolling along, and then we have a few things to share. And if you've got any questions, I'm watching the chat tonight, which is awesome. So chuck something in the chat if you've got any questions for us. We've always got a few things to kick off and sort of debrief on the week. But Andy, what do you got this week, mate? What's been going on in your neck of the woods?
Mate, on an investment side, it's been interesting. We saw for the first time, and some of the things that we've chatted about previously, we saw the rattling of the big giant growth stocks over in the US. That was just this morning. They finished up about 3.5% down over the Friday, and it's really, really, really interesting the way that markets are reacting at the moment. And I don't know whether anybody's been following how much Mr. Trump's been on television, but he's stepped up his political game, and we should all be afraid of that, I reckon. But mate, he's been on literally, I reckon, every day since Monday. I think he's had something to say. And the first time he came out, it sounded very much like a campaign, but more and more he's starting to address the real issues of what's happening behind the scenes with COVID-19 over in the States.
Yeah, right.
Not all of it's great news. So we saw the first rattling of the major tech stocks. So I'll show you where they're down in a little bit. I've got a few of the images, but so we saw that. So as a result of that, we saw gold start to rally, and I haven't been able to find a slide of mine, but I'll drop a few tips on you in a little bit about the old silver, the silver trail, as I call it. So we've seen the beginning of one of my old theories come back to life. And we saw that second round of stimulus starting to drop, which was expected. And I've got a few things on JobKeeper 2.0, which I think is the government.
So, yeah, exactly. You and I were saying this for weeks and weeks. Lots of media, media morons. I don't know. Maybe it's a bit harsh, but They like
It's
to
not
carry
us.
on like a bunch of pork chops, whip up a bunch of frenzy. At the end of the day, the government came in with, an opportunity to, create some stimulus and some safety packages. They're not just going to rip it out. And, again, you and I sort of having a sensible conversation going, well, we couldn't see how they could just rip it out on, come September. Nah, that's it, gang. So obviously now they've extended it, or they're changing it or improving it. So it'd be great to get a bit of a debrief on that, Andy. See what that looks like.
And we've got, I guess, from my perspective, it's pace and lead is my theme of the week, and from that side, America is going to lead us through the repeal of stimulus. So it'll be a really interesting forecast of what's to come here. So mate, we may have the the car in front of us during a blizzard, which can be a really, really good thing unless it runs into a deer.
Mate, so to be really explicit, that's the US in front of us, right? And we're behind. Is that what you're saying?
That's basically right. Yep, that's right.
Mate, well, good. Well, in the real estate world, I think I don't know if I mentioned it last week, but the $25,000 home builder stimulus has almost been doubly oversubscribed, so almost 200% subscribed. Which is fantastic. Like our guest last week, Ennio was saying that, in his world, lots and lots of jobs being called, and he's having some really interesting times. So that's pretty cool. The government just released some figures forecasting the 2021 financial year or calendar year, immigration, overseas immigration, to drop to between sort of 30 and 35,000 people. A lot of people are concerned about that. Obviously, that does have, in the past, it has boosted the real estate world a little bit. And, for me and where we're heading with the real estate marketplace, I'm not concerned with that one. Really, at the end of the day, what we do have right now is we're entering into the worst construction supply we've ever seen. Last week I mentioned secondary commercial lenders are pulling out of the development market. They're pulling out of certain commercial markets for commercial lending. I think I don't think it's called naturally, but what's going on will tighten. But as soon as the government can, they will let migration or overseas immigration happen. And what won't happen is the reaction time frame of the development marketplace or the construction world won't be able to effectively respond as quick as we could turn the tap back on and let people back into the country. So, the development cycle in Australia is a 3 to 5 year cycle. So 3 to 5 years to get back up to production pace. And if you look at any markets in the past, you see supply markets, after the GFC is a good recent local example where the GFC comes sort of, 10, 11, 12, had a real sort of downturn when it came to production. And by late 2016, early 2017, we'd gone from low lows to high highs. So, that time frame, 3 to 5 years, producing lots of, and the medium density stuff is the stuff that gets produced quicker, townhouses and apartments, obviously, because you can build more in one little spot rather than houses and expand out. So, that's a pretty interesting one when you have a bit of a look at it. So, a little bit of tightening down in Victoria. Melbourne certainly has had some squeezes on its rental yields. And so interesting times in that sort of space, certainly for a bunch of investors. A bit harder for property managers to get around, a bit harder for tenants to get around. A lot of people had already sort of felt like they'd gotten through that one and, come back again for a second round. But what we're sort of noticing right now, there's still people applying for tenancies online. So the good property managers are actually still getting applications and getting people in. our guys in Melbourne. We've got a property management business in Melbourne. They were able to lease, a number of properties, basically, sight unseen or through video or virtual walkthroughs. So it was quite good. But it wasn't sort of end of the world, but it is certainly much more difficult for the property managers and the property management world in Victoria at the moment. But what we're seeing in Queensland, the team up there are putting the rents up. The rents are going up in the middle of COVID. So, really interesting times. What we do know, what I do know from my experience in real estate, and many other people have sort of said this one as well, when you see the rents go up, it is a bit of a precursor at some point to values increasing. So, at the end of the day, the rents will get to a point where, people will say, bugger this, it's just way cheaper to buy the thing. And then that's what happens, the properties owner occupiers pay too much for real estate. That's what happens. It's pretty normal. And they set new benchmarks in new areas when it comes to real estate prices.
Mate, that murmur's already happening down here in Victoria, where a lot of people are basically saying now, you know what, it's cheaper to buy a house than what it is to rent them. And the difference, and you and I both know it, is that there's a difference between the person who's going to buy the property and the person who's going to rent. One's a safe game, and one is it's a safe game and the lack of ability. So it's one or two reasons, right? They're either playing it safe or they don't have the ability.
Yeah.
And then there's the ones who do have the ability to achieve the funding to be able to acquire the property, but whether they take the risk is another question. So we'll see that one play out. Usually in the past, we've seen this play out over a lot longer cycles, as in, that you and I have been talking about how quickly things happen these days with the freedom of information and, as you say, realestate.com and its pricing transparency. Mate, I'd imagine that this thing has the capacity to start to close the arbitrage reasonably quickly.
Very quickly. Let me just show you. Here's something I prepared a little bit earlier. At the end of the day, this sort of thing, if you have a look here, these are the recovery periods in the past for the real estate game, and the recovery, in 2009, the recovery or a recovery of, a reasonable amount from a disaster, according to the, the old media, to, decent financial gains, quite quickly. You can see, the 83, 84 one there, that one's a little bit of sort of a left fielder, but really at the end of the day, 2009 and most people don't even realize that we actually had quite a significant reduction in house pricing from middle 2019 to sort of the first couple of months of 2020 or the first 1 or 2 months. But then we had a strong rally as the interest rates went down. Over 10 months there was a positive gain. But I completely agree that the speed of these recoveries, and you're talking about it as well with the speed of money and the transactional, timeframes. I think recoveries, problems and recoveries, certainly are facilitated quicker in this game. My game, they're in the real estate world, there'll be one physical issue, and that is the ability for the banks to process loans. When that is gone, when that is blockchain and you don't need a human to go, oh yeah, I'll give Andy a loan, I think the real estate market will move, fairly similarly to the share market. But let's see, that's probably 10, 15, 20 years away. But I think that's out over the horizon. I think that's coming at some point, to be honest. I think it's something that we've all got to plan for, one of these days. But, that recovery time is an interesting one, because right now, what's being loaded up, what's being backed up right now in both of our markets, I'm sure you could probably attest to this. There are plenty of people in cash positions right now and going, I'm just getting ready, and when I see the right signal, I'm going for it, right? Both of our worlds will see, good buying opportunities, whatever they are, for that person with, the loaded opportunity, full of cash or full of lending position and ready to go. Because the people in my world, those who can borrow right now, they've got good choice, and they're buying some interesting things. What's interesting right now for me is, I wouldn't say there's price drops across the board. That's not happening. I'm not seeing any of that at all in the real estate game. Like, people aren't dropping their pants and going, here, have it for 100 grand less and running away. Not like in the GFC. That happened in the GFC. I think there's enough relief for vendors of owning real estate because the banks are sort of taking that brunt right now. That might change in the future. But what is happening, I call this concept the proximity of profit. You're actually able to purchase closer to profit centers, profit infrastructure right now than you were able to when the market was a bit more buoyant. So you're able to move your purchase closer to the city, closer to the train station, closer to the infrastructure that you want, the beach, the whatever, because the market's a little less bullish and there's a little less competition. So, it's interesting. It's interesting in that sort of space right now.
Yeah, I think the property is not my thing, but logically sort of thinking through it is that at the moment, in the GFC was a take no prisoners affair, right? It crunched, it went hard, and the only people who got supported were the banks. Right? Yeah. And they got bailed out by the government. But really, for small to medium businesses and everybody else, nobody saw a lick of cash. There was no subsidy in the market. There was no save the taxi drivers from Uber. There was none of this sort of stuff. So,
no, there wasn't.
That was my little jab at the taxi drivers, but love you guys. But this time, there's a difference. And again, this is where history doesn't repeat itself, but it's a very strong mimic, right? And we've seen the stimulus dropped into our hands, all right, on a reasonably large, I'm getting sick of listening to the word unprecedented. But my point being to this is that when there's take no prisoners type of effect, everyone gets smashed and gets hit hard and instantaneously almost. Yeah, which means that the whole landscape is in the same position. What we're seeing now is that the whole landscape isn't in the same position. There are people who have just been belted and just knocked to the ground, right? And if you're 2-3 months in at Elwood in Victoria on a beautiful $1 million property that's just near the beach, and now you're on JobKeeper, look, you'll defer your loans, but if you've lost your job, are you going to be able to continue to service this as at the time when the relief comes? Probably not. So you'd have to think that there's going to be not what we saw in the GFC, where suburbs had big price corrections, but you'll probably see it, thinking rationally through it, you're probably just going to see little opportunities pop up where other people have just obviously not been able to maintain their positions. But I don't see it as a blanket cut. Does that make sense? Like
100%. It makes sense, because it'll be sort of dotted everywhere, really, at the end of the day. It won't be sort of concentrated. It's interesting because, I think actually right now, there's plenty of runway for this stuff, and anyone who's paying attention and not sticking their heads in the sand, I think, practically you'd say, well, shit, I've got a problem in 4 months' time. What do I do about it? I've got some runway here. I've got a 4-6 month bit of runway. I can solve this problem. And, I think it's been quite clever. It's been quite smart. The government, whether it was the full strategy or not, they thought it through, or they go, well, we'll just do this bit, and the knock-on effects actually been gone their way. It's kind of 50-50 with a flick of a coin, this sort of stuff. Well, but
it's not 50-50, mate. They looked over their shoulder. They said, "What's the rest of the world doing?" Case. They use the case principle: copy and steal everything.
Well, interesting. This is interesting. I was doing was doing a little bit of research for someone on Facebook. They're having a little bit of an uneducated complaint about property investors getting, tax deductions and all this sort of rubbish. Negative gearing destroys the planet, and negative gearing caused COVID, all this sort of stuff. But which is a bunch of rubbish and bullshit. But it's really interesting. So tell me this one, Andy. How many landlords are there in Australia registered with the ATO? This was some stats I found out. Do you know the number?
I'll throw it out there. As in landlords with tenants. So landlords. Okay. So I'll put it. I'll go investors. 3.4 mil. 1.3
million. All right. Not as many as people think. So, everyone's sort of like, all these investors are buying all these properties. Rubbish. Move on. So the average loss or negative gearing that was claimed, $9,156. And so collectively, that for all of those property investors, $693 million worth of tax deductions. $693 million. That's unbelievable. Unbelievable. That's destroying the country. All right. Well, let's work out how much in tax those investors paid in GST, land tax, stamp duties, capital gains. You name all the taxes. What would be the number, Andy? The dollar amount of these dirty, filthy property investors who've claimed all these tax deductions and destroying the marketplace and adding no value to the community. How much? And I'll tell you, I'll give you that it has to be $1 billion, not $1 million, this number. How many billion per annum from property was the tax collection in 2018, 2019 that the government collected from property investors? Tell me the number.
So what did you say? 1.3 million.
1.3 million
times.
Well, that's landlords, right?
Let's just go. I reckon somewhere 2.9.
$32.6 billion.
29 was my answer. I miscounted the zero.
I just need to move the point. So it's an inch.
It was there. I just misread the power.
You're dead right. There you go. So interesting, isn't it? Right? We can get a bit carried away. And my point of this is that stimulus is smart because the government stimulating, tens of thousands of properties being constructed, that is going to pour billions of dollars of tax money back into the system, and into the future. Councils and governments and stuff like that, GST and other bits and pieces. It's interesting. It's interesting what they give away. I guarantee that they would have done the math. We'll give everyone 25 grand, but you know what? I reckon we'll get 50 to 70 grand back for the 25. So we're net up, so it's interesting. It's I'm not an actuary, but you're way better at this stuff than me, mate. But
2.9 billion to 29 billion, mate. I think I better hang up the actuary booth. But you planning on a little bit of run for local council over there, are you, mate? That's
mate. I tell you, so you're starting me down this track. As a business owner, you're a business owner. Like we get a shit deal when it comes to lending. Like we employ people. We take risk. The most risky thing on the planet is being a business owner. Like we get poleaxed, bucking left, right, and centre, and Australia doesn't particularly appreciate entrepreneurs. America does, but most people do the old tall poppy. So it's a real kick in the teeth when I open up my interest rate from my lending today is 5.9% because I'm a self-employed fucking business owner, and the people I employ can get a 1.9% loan because they have a fucking job. It drives me insane. So, any politicians listening in, pull your fucking heads in and help us out. That's bullshit,
Sounds like Jason's coming for you.
I'm coming.
Yeah, you do often feel like saying to the good old bank manager, it's like, Because they go, well, why is that? Oh, you're a bigger risk. And we go, well, how's about I just fire all of those employees? Now, how big a risk are all of them?
Yeah. What about the people? Oh yeah. I love everyone who works with me, like love them to death. But at the end of the day, the reward as a business owner sometimes is, a bit non-existent. Which is a real bit of kicking the teeth. But anyway, I'm getting a bit bloody down in the dumps on this thing. I'm just getting a bit fired up. Don't worry, gang.
Mate, no, I'm with you. If I didn't love what I do, and I reckon there'll probably be a point in time in the future that there might be a bit of the Andy and Jason run for small business party.
Mate, I tell you what, that's not a bad idea, man, because most politicians have no idea about how to represent small business, and even depending on, don't care who you vote for, small business is the backbone of this country, and
yep.
They walk into bullets for their people. There's just not enough care for them as far as I'm concerned. But
and now we're the biggest distributor of welfare.
There you go. Thankfully, there's a system for the government to use now to distribute the welfare. Exactly.
I'm just waiting to throw that invoice into the ATO for managing their welfare.
To be honest, maybe in the last 4 months is probably, I can't complain. They have given us a break for the first time in my 22-year entrepreneurial career. Mate, they haven't missed a fucking beat to kick me, whether I'm up, down, or sideways. But for the last 4 months, they've taken care of me, and I'm taking care of others, which I'm grateful for. But far out, has it taken a pandemic for them to realise that small business is the bloody caretaker of the community? Anyway, we're getting a bit political here, Andy.
No, and the truth is they don't realise that, mate. It's just at this point in time, they call it pigeon business because there's that many of us and we cause that much shit, and that shit is profit and people employed. For the old politicians, that was a great one. Old pigeon business.
Pigeon business, mate. Yeah. If you want people to get back to work, support the bloody businesses. That's for sure. Anyway, mate. Well, we might kick it off. We've got 30 supporters online tonight, so that's a good way to get our party started.
That's it. That'll make a dent in the House of Reps.
No, mate. All good. Well, listen. Interesting times going on, mate. Tell us a little bit about the market, mate. What's happening in your neck of the woods? Reporting season, the US, all sorts of stuff. What's going on?
Well, mate, I'll just take you through the headline slides of what I saw this morning while I was cycling away. I didn't put it into any specific format. I'll go down the bottom here and I'll point up to the top over there. And that's bloody hard to do. Call me the weatherman.
Mate, you did that really well, mate. Good work.
Thank you very much. Thank you. It's taken a long time to do it. Nowadays, when I try and point to something which is actually over there, I end up going like that.
You're like, shit.
Where is it? Where am I? I'm over there. So this is actually going to lead somewhere. So for those of you who are listening, I'm not just going to wax lyrical. I've thought about this all day, and this is actually a theme that I've been picking up on probably for the last decade. But so this is the first time that the big stocks rattled. So what I'm going to talk about here is I'm going to talk about small to medium business and how to manage through the stimulus. I'm going to talk about markets and how they react to political decisions and stimulus. And then I'm going to also talk about opportunities and precious metals. So Jeremy and Lindsay, if you're listening, you guys will be happy as a pig in proverbial with what I'm about to go through. And I'm going to drop a bomb on it that I think I've spoken to both of you about at a point in time, but you may not remember it. So let's just have a look at what we saw on Wall Street just this morning. And I'm not saying this is a long-term trend, but this is the first sign of instability of the big boys on town. So we actually had the S&P down by about 1.2%. That's the biggest fall in the last month or so. Had the Nasdaq down 2.67%. The Nasdaq is just exploded. First little bit of negative signs out of them, and the FANGs, which is Facebook, Amazon, Netflix, and Google. which is interesting because Google's listed name is Alphabet. So it should be Fanger, which I think is more appropriate for us Australians. Right. So that's the big tech stock industry. First time we saw a little bit of a bit of market turbulence. So you'd ask yourself, why? What changed between yesterday when they were flying and today? There's been some earnings results. And on the earnings results, and when I mean earnings, it's when companies actually talk about the profits. And so Microsoft was a little bit shy of it, but have a look at this. Look at this as a bit of carnage. Microsoft hadn't done as well out of the cloud computing as what they were expected to do. They released, so they were down 4.35. But Apple hadn't released any statistics on their earnings as yet, down by exactly the same margin. So there's been a pretty considerable sell-off of these major FANG stocks that are sitting here. Well, Microsoft isn't a FANG. So big sell-off in the top end of town. And did I have one more on this? And then when we had a look at the chip space, I just thought this was an interesting one because Intel actually came out with its forecast and they were pretty reasonable forecasts, a little bit down on expectation, but Intel got absolutely smashed.
Yeah, right.
So why am I saying all of this and where am I going with all of this? Because, well, you don't bag these stocks because these guys have just had an absolute massive run, right? They've just you remember the graphs that we showed last week? They go like that, right? And it's all like that. So why wouldn't they keep going? Oh, by the way, Tesla, Jesus, far out. Tesla keeps defying the odds. Tesla's shot its stock price into orbit, and Tesla is now, or is capable of being part of the S&P 500. So one stock that might buck the trend, and I reckon it will, because I reckon Elon Musk actually controls the world with his mind.
It's got that Apple feel, right? It's kind of like you're not, like you believe Elon's got something special. Like it just, I saw it randomly somewhere, but is now Tesla the largest automotive producer in the world or something like that? Like,
not producer, it's the largest market capitalization of any automotive production company in the world.
There you go.
Now, how many cars do you reckon Daimler put out every year?
Well, this is interesting.
Daimler being Mercedes-Benz.
Yeah, I don't know. Tell me the numbers.
I got no idea, but it's well above.
I thought you were going to drop a bomb there, Andy.
I wish I'd thought of it beforehand, but logically thinking through it,
listen. We need a researcher like what's his name? He does that podcast, and he's got a bloke sitting there always doing this stuff. The Joe Rogan. We need a researcher. We need a pull that one up.
Let me just touch my research button. 7 million was the production number, but think of Daimler, massive Mercedes-Benz, massive company all around the world. Yeah. Its annual production is well over 500,000 by an absolute country mile, well over 500,000. We'd be talking millions, right, per year. At the moment, Tesla is forecast to have, from its original forecast, 500,000 units, and that's a massive stretch target. But here's this: they sold 90,000 units in the COVID quarter. 90,000 units in the COVID quarter, which is just staggering.
Crazy.
Now, perhaps they have a different market demographic, and that's all well and good. But anyway, I wasn't going to chat about them, but they are literally defying gravity. And if you really wanted to take a punt on something, there's something that it wouldn't be a bad idea, because they defy logic. And now that they're part of the S&P 500, as soon as that happens, then all of the fund managers will have to buy their stock, and it'll get a natural kick as a result of it. But one to watch. I reckon ultimately it'll go the same way as everybody else. So point being, market's been hot in all the growth stocks, and growth stocks are effectively those stocks that people just see are gaining market capitalization, gaining distribution, just becoming bigger and bigger and bigger. Doesn't necessarily mean that they're profitable. It just means that they're gobbling up distribution and getting more scale to their operations.
Yeah.
So we've seen a growth-dominated market, and that makes sense, right? Because ostensibly, who is actually profitable in a mass way in this market? Well, the banks aren't, that's for sure. The growth companies, really, Netflix, no, they spend more money making films and what they do, through their revenue of their consumers. And probably one of the reasons why they'll do well now is because they haven't been able to make as many movies, right? So as a result, their
not allowed
profits
to spend as much money. Yeah.
Right. But these fundamental stocks that are the backbone of the world don't have the forward, and they're called value stocks. They don't have the forward multiples because they don't have the revenue at the moment. So it's been on this big growth journey, and we've just seen the first wavering of that. So you go, Andy, why are you rabbiting on about it and getting so vocal about it? It's dropped 2%, but it's shot up by 40. It's a good question, Jason. And
glad I asked.
In a very sexy voice, I might add, in a very, very sexy voice. And my belief behind this is that this is the first. So what is about to finish is the first round of government stimulus over in the US.
Yeah, right.
Now, all of a sudden, everybody's focused on job numbers. Job numbers are down, suppressed. Trump is now talking about the coronavirus. Why do you think he's talking about the coronavirus? And why do you think he's calling the coronavirus the China virus? Well, because he's a bit of a tool, in case nobody's picked that up. But I stick with this. He is either an unrequited genius of epic proportion, or he's senile. That was my basic belief. So he's now coming out with the China virus, very intentionally named, and he's talking about it a lot more. Why? Because Trump has been talking about how markets have been buoyant and how he's made markets buoyant, but now they're repealing the stimulus or not repealing it. Now parts of the stimulus are starting to come offline, right? Or are, weeks away from coming offline. So we've seen our first bit of growth turbulence. Now, my belief is that when we see more of that growth turbulence, we're going to see more of that potential sell-off in those big growth stories. And the more that Trump starts talking about the China virus, probably the more he is then focused on the enemy of my enemy is my friend. So he'll be focusing it over on China. And meanwhile, he'll allow the stimulus to slowly start to dissipate, possibly, or they'll re-stimulate. But either which way,
yeah,
my fundamental belief is that the market will start to correct itself a little bit as the stimulus starts to turn offline. So why is that important? Well, the correlation of the market drop to that commentary about the stimulus not continuing or being clawed back, almost instantaneous. The S&P out here, the All Ords, now 6,100. They were 6,250, right? Over the last few days, they've dropped as a result of JobKeeper, which I'm going to talk about in a moment as to what that looks like. So if you remember the graphs, when they repeal the stimulus, the markets sort of start to follow, especially the big growth stocks. So what's happened in Australia? So this is from our beautiful friends that I spend all of my time worshipping and loving, which is the Chartered Accountants. All right. So JobKeeper 2.0. Do you know what, guys? When it comes to commentary and using catchy slogans, just don't do it when you're a politician. All right, because it just doesn't sound right. It's Terminator 2.0. It is Finance 2.0. These are cool things. You don't call it JobKeeper 2.0. That's just my take on things. So JobKeeper, just to run through the facts. Now this is from the CPA, but we'll stick it in both of our feeds so that you can have a look at it, because it's a very quick summary. Don't really need to go through JobKeeper 1.0 as good old ScoMo named it. It's like, no, it's just JobKeeper, dude. It's not JobKeeper 1.0 and JobKeeper 2.0. It's get with Twitter, get with TikTok, get with the dialogue. So JobKeeper 2.0. There's basically no changes to the percentages here. So the percentage tests are exactly the same, right? 30%, 50%, or 15%. So for most of us watching this, we're in the small to medium business, so it's 30%. Right, as a measurable decline. So to be eligible from end of September, so this current round of JobKeeper finishes in September, right? But JobKeeper 2.0 is going to commence in September, right? But you have to qualify in the September quarter as a business. That's the first thing. You have to qualify by one of these measures in the September quarter by your actual figures, not your forecast figures. So here's the thing. You have to apply before you know whether you'll be able to get it in order to receive it. That's the ballpark. That's the basic drum here. So they're not accepting forecasts. They're only accepting actuals, but you have to forecast in order to figure out whether you actually should go into it. Not my logic, it's the government's, but they're handing stuff out. So let's just sort of stick to it. So a measurable decline in actual GST turnover in both June and September quarters. All right. So if you qualified in the June quarter, you have to have qualified in the June quarter and the September quarter, right? So now there's dual responsibilities. You have to be qualifying twice. And then when we have a look at, if we want to continue it from the 4th of January, because this is now out to the 28th of March, which is almost when this whole thing started, right? You've got to have the measurable decline using actual GST turnover. So that's revenue that's the money into your business, total money into your business. In each of the June quarter, the September quarter, and the December quarter, right? So you need to qualify according to this in each, right? So which begs the question that haven't been answered yet. What happens if you qualify in June, but you don't in September, but you do in December, right? So these are questions that we will answer and we'll come back and talk about over time. But these are things that you need to be looking for. So of course, no businesses are going to manufacture their revenue in order to be able to achieve it. That would never happen. But if they were thinking about doing it, they'd be thinking about doing it now. But I'm sure that if you do try and manufacture it, that they're going to have their watchdogs out and they're just looking for somebody to make an example of. So what's the reality of the JobKeeper? And so I'm going to link this back to markets. All right, so here's the first big one, all right, is the 20 hours worked. All right, so if you worked over 20 hours per week prior to all of this COVID stuff coming in, right, this is the key. If you worked over 20 hours, then you will be eligible per fortnight for 1,200, not 1,500, for 1,200, right? That's from September. And then it'll drop to 1,000 from January to the end of March. So what we're seeing is a staged repealing of stimulus.
Yeah.
Right. Yeah. Again, doesn't repeat, but it mimics. But there are signs and there are breadcrumbs that we need to follow in order to figure out what's going on here. Now, here's the key, right? Because what ended up happening was there were a lot of people who are casually employed who weren't even earning 1,500, but all of a sudden they went JobKeeper, sensational. I've just doubled my wage.
Yeah. I know.
Happy days.
Yeah.
They were the ones who were having parties in Airbnbs all around Melbourne. That's right. And probably they were the security guards who were, actually, let's not go there. Let's not go. It's a bit early for me to talk about their shenanigans, isn't it? So 700 is going to be the maximum benefit that they'll be able to get.
750, yeah.
750, sorry. And then 650. And this is the big one. So in March, it stops.
Yeah.
So-called, right? So they're giving, which is very smart. They're going, you know what, let's stop the short game. Let's launch long-term. Let's go. This is where it's coming. Everybody work to this drum.
I think that's smart. It's great. You've got a runway, you've got a time frame, you've got a stage, a step, get your shit together. We're going to give you 9 months. Get on with it,
Yep.
7 months or whatever it is. Yeah. That's great.
Yeah. We're going to make a baby, an economic baby. Right. So the big change here is if you had 2 jobs, then you can apply twice. That I didn't see coming, because that is a logistical nightmare, is a paper nightmare. So I haven't seen any info on it yet, but it'll be interesting to see how that comes out.
Yeah, right. Yeah, crikey.
So let's have a look at this from a business perspective. We need to understand And you remember when I was talking about the seasons of stimulus?
Yeah.
We were talking about. Let me just jump into this. We were talking about the various different seasons, and let's just say, well, summer is still on, but I called it. I sort of said, I reckon we'll have a long summer, which ends up spilling over into autumn, right? So this stimulus, if we put it on a scale like this, it's gone like that, and then as we hit September, it sort of drops off like this. And understand that the businesses that don't qualify for the new JobKeeper, so they might have qualified initially, but they may not qualify in the next, right? So not only will we see a reduction in the amount, we'll see a reduction in the amount of people who can take it. And then again, if you have to have qualified here, here, and here, then we're going to see a further decline. So effectively, what that means is how much money is in the system from the government. Well, we know, based on what they've forecast out now, we know that that's going to decline. So we then know that based on what we're seeing over in the US, if that continues to run true, well, we know that some of these growth games that are being played, they're likely to start to ease off, and they're likely to start to feel a little bit more pain. What's going to start to then become more attractive? So if the growth game's off, what do you look for?
The yield game is on.
Yep, the yield game is on. And yield equals value.
Yeah. Yeah, and
so
you can
value game,
right. So there's, or you can potentially go, wow, there's the gap. Yield equals value. Yeah.
So when we look at it from an investor perspective, we start to go, well, we had a big kick in our growth stocks domestically and internationally. Well, if they're going to repeal the stimulus, now we need to start to look at cash flow, businesses that have good cash flow, because all of a sudden that cash flow is going to become safety.
Yeah.
Right. So what happens in between good cash flow and safety?
Nothing. I don't know. What do people sell off? Do they cash up? Do they go liquid?
They shit the bed and they shit themselves, Jace.
So they sell their stuff and they put it in cash. Yeah.
So we've got this. I haven't given myself enough room on this, and this is just my own analysis, my own theories. But let's just watch and see whether this time it works true. It did last time. Like, let's just say that that's gold price.
Yeah.
What we end up seeing is this kind of correlation, and this is sort of silver. But what we've seen in markets is that towards the peak of gold in the history, and this is just chart analysis, and this is my chart analysis, so this could be complete bullshit. But what we see is silver gets very, very close. It doesn't reach parity with gold, right? But it becomes very, very, it closes that gap very substantially. So why do people flood into gold? Because the growth stocks have started to waver. People shit themselves. They go, gold, the world's going to end. So they jump into gold, so storage of wealth. Then what happens when gold starts to become overpriced? People go, we've missed the boat. So what do they start to look at? Or as gold is really hung along, they go, geez, gold's going gangbusters. What else is there, Jace? What else is there? What else can we get our mitts on?
Yeah.
And you've got palladium, you've got all of these other things in silver. So let's see if this runs true. Because typically in the past, what ends up happening just before gold hits a peak is silver bridges the gap substantially. And what we've just started to see is silver really start to run hot. And that is, in the past, from a trend analysis, when silver runs really hot, that is a signal that gold is about to turn a corner. Because when they catch up with each other, silver can't be more expensive than gold, right? It can't.
So gold turn a corner as in go down.
Well, yeah, or flatten off,
Yeah.
or go down. In history on chart analysis, it's gone down.
Yeah.
Right, because it bridges a gap in investor mentality between growth and value.
Gotcha.
And this works perfectly into a business analysis. If we go, okay, we've got the 4 seasons and we've got summer, autumn, winter, spring. Well, here we got stimulus, which is dollars into our business through JobKeeper, through tax cuts, so on and so forth. In autumn, we're still maybe getting it, but maybe a little bit less, right? And we're still getting our tax cuts, but get ready because tax is going to come back online in winter and stimulus ain't going to be there.
Mm.
So as a business, what do we need to be? We need to plan for here and understand that while it's game on over here, we need to be very, very careful about what we're doing with our additional resources. If you've got the capacity to scale, but don't scale for scale's sake, right? Because if they turn off the tap here, right, and you don't have the ability to bridge this 3 months, or it might be 6 months until spring comes, then you might really scale yourself into disaster. So the next couple of months the next couple of seasons are a really pragmatic game that we need to be aware of.
Yeah.
And you can kind of see it, stimulus coming off, politicians deflecting to, China. As soon as ScoMo starts talking about China, fucking put on the brakes and put money into gold. Right? And then get ready for this period of time. As an investor,
that's where you can deploy. You can nick a deal or two. Yeah.
Yeah. And look, it's impossible to time this stuff exactly because this happens differently every single time. But if we map it out logically and we look capital injections in, political conversations, where markets are at, money in people's pockets, these things are going to work out very true. And as a business owner, if you make astute decisions with what you do here and you don't just scale for scale's sake, only to be hit, because what happens when you scale, Jace? You put on 20 more team members and you're not paying tax on their wage. What happens in winter?
Well, and also too, you have a forward cost commitment. That's what happens when you scale in people, places, whatever you're doing, like commitments, you have a forward. It's not today, it's the cost of the next 12, 18 months, 2 years. You've got to commit, and that's one of the things that we've been, quite strategic about reversing out of right now, which is long-term leases for our businesses, assets and liabilities, our balance sheet, right? A liability on your balance sheet is a 5-year lease. If you're into it for $1 million, that doesn't look great. But if you don't have a 5-year lease and it's a month to month, you're looking pretty good. So, that's the same of any commitment, whether a person, people commitment, talent commitment, or a physical commitment. So yeah, dead right. Absolutely.
Mate, that's a good point, because I had a conversation a couple of times this week and I promised myself and to them I'd ask you about it. And I'm not sure if you know, but when does that arrangement that the government made in regards to landlords having to come to the table, minimum 50% reduction, and then how long does that play out till? When does that finish up? Because I haven't put that into my seasons.
Yeah, listen, it was assumed it was a 6-month window also. So along with the
September.
Yeah, along with the bank, so September. What still has not been updated or changed is the code of conduct, which is, most vendors or landlords who've got some good legal representation are saying, here's the code of conduct, show us your drop-in turnover, and we will give you the reduction in your rent compared to the reduction in your turnover. So very much like what the government is saying for JobKeeper. Like before it was all pretty grey, like, you could work the numbers and get through, but now it's like, you got to qualify this quarter, that quarter, and that quarter, and it's boom, boom, boom. So it will get tighter, I would expect.
And here's the sneaky thing that I'm wondering, Jace, because there's been speculation and look, it's dropped recently, so we don't know the finer details. But if they really want to tighten the screws, they might say that you need to qualify quarter to quarter. And what I mean by that, quarter comparison, not 1 month in the quarter, but quarter to quarter comparison. So it'll be really interesting to see how that comes out. And I reckon if that comes out, there'll be a bit of a hit. And so, but here's the beauty about it is there's always opportunities within opportunities, and it's understanding how these opportunities relate with each other.
Mate,
because
right.
I think with the speed of which things happen now, is that this is really suppressed. Like, and I'll see if I can gather some of the statistical analysis that I used to have, and I'm almost positive that when it comes to the equity drop and the property drop in the GFC to the gold and silver rise, I think we're going to see that they're protracted. They're longer, and I reckon this time they're going to be substantially shorter. Like, yeah, like by a factor of 50%, if not more.
Yeah.
And as I said, it's a mimic, but the same sorts of trends seem to come out, and a lot of it's because it's behavioural, it's psychology, it's a psychological bias that goes in. It's like, we got to get into precious metals. Why do you get into precious metals? Because you fear about markets. So is it only gold? Well, no, it could be anything. And you go, well, nothing else is good. So you look for other opportunities. And then eventually it goes back to value, which is about forward cash flows. And it always
goes
has.
back to try and making sense, right? It's just like, if I'm not receiving the growth and it's costing me to hold this thing, what's the point? Hang on, why am I paying to own this thing? It's not even growing, right? The growth story is great. And that was one of the things that actually, it was the great leverage bubble that sort of eventually blew up in the GFC, and one of my early strategies I remember teaching in the early 2000s is, listen, don't worry about negative cash flow property. You just keep moving up your LVR on your property when the property grows next year, and you just redraw that extra 20, 30 grand of equity, and it'll continue to outstrip the negative cash flow. Don't worry about it. Right? And that literally was the story for a full decade. The growth covered the sins of the property's capacity to pay for itself, and then boom, all of a sudden, I remember, and you're talking about value stock based on yield, and that was after the GFC. Sydney for the first time in my entire life, 22 years of paying attention to the real estate market, Sydney real estate was producing a yield of 7%, 7% in the biggest capital city of Australia. Now, the interest rates were, 8.5%, but the yield variation was just insane. And we're like, this is bullshit. Like a 7% yield in Sydney is unheard of. The 40-year average is, 5%. It's undervalued. Get into Sydney. So, we were really bullish about that sort of thing. So, it's interesting when you sort of have a look at those things. But I've got a little chart maybe to have a little look at the something similar to what you were saying. When it comes to silver and gold, we have a look at, let's call it, I don't know, copper, silver, and gold. What's number 3? Is it is it copper or bronze or?
Well, there's palladium, there's platinum, and then there's rare earths.
Well, let's just call Brisbane the platinum. All right, platinum, silver, and gold. But if you have a look at the difference between Brisbane and Sydney median value right now, that's the biggest median value gap we've had as a percentage for over 2 decades between Sydney and Brisbane. And what we do see is in the real estate game, the southern investors look for value because Sydney's gross or net rental yield is kind of middle 2%, where the net rental yield for a good Brisbane property is early 4s, middle 4%. So it's 50% more income value to purchase a property in Brisbane than it is to purchase a property in Sydney. And right now, the Sydney growth, is nothing compared to the Queensland Brisbane growth. So, Melbourne right now, again, I think Melbourne's is still excellent value if you know what you're doing. But, the Brisbane to Sydney arbitrage is absolutely immense. as at
And again,
June
it
30,
makes sense
2020.
though, doesn't it? Because right now, like, because there are people who react very, very quickly to times like this, and sometimes it's good, sometimes it's not.
Yeah.
But having the conversation with clients who are in Queensland today, you know, their reaction is, I was like, so have you had social distancing? Like, and they're like, oh, they're thinking about throwing a fair or a show up there, and for the industry. And this person's going, I don't want them to throw a fair for our industry. Just no, we don't want it up here. But the reality was that the impact up there was so much less than down here. So if you're down here at the moment, like you know what I'm talking about.
Yeah.
And so people down here are probably sitting there going, you know what, I'm checking out. I'm going to Brisbane. And what we've seen over periods of time in the early 2000s, I think it was, and there was a mass migration to the north of the New South Wales border, and it was because Macquarie, the banks, everyone started setting up their not telecommunications hub, but effectively that's what it was, right? It was they put their call centers in Queensland because they used to be in Tasmania. Right. And then all of a sudden, you know, Brisbane got a bit cheap. And so they sent everybody up there. And then all of a sudden you had a real big boom in Queensland for a little while because the big companies took people up there. There's a real possibility for a medium term type of shift to out of certain areas like your Richmonds and stuff like that, out to the periphery suburbs so you can live on land and all of those sorts of things.
Mate,
I guess
100%.
the big question is, does that create a real price opportunity, or is that going to be a sustained long-term shift?
I think it's going to be a sustained long-term shift and a price opportunity as well. What's the number one thing that's going to facilitate that, Andy? There's one thing that's going to facilitate
the Queensland side, or the
not the Queensland side, but the rural shift, like that value shift to that type of living. One thing, and Australia's fucked it up. Excuse the French.
It's internet, right?
Yeah,
it's being able to stay connected.
Boom. And right now we are seeing like a $100, 20% differentials between buildings that have high-speed internet and shit old internet, like, because the infrastructure, the physical infrastructure in those buildings is fucked. Like, for rentals.
We're starting the conversations of getting fiber to the property, because it's slightly subsidized. They got the inside scoop from a client of mine and said that they're going to subsidize certain amounts of it.
Yeah,
because not just we need it. Right? The fact that we can do wine and wisdom on a Friday is probably because nobody's tuning in. I don't know, but our internet seems to be able to survive. But
I was doing a course today, and literally when every kid in Victoria, because we had some Victorians dialing in, when every kid dialed in at 9 a.m, all the Victorians, their internet, like their videos were off, and our internet's stuffed, and so that's an interesting thing. And one thing I think, mate, might be worth us, weaving around to maybe next week. Might be a good time to sort of call it a night on wine and wisdom. But what are the lessons from COVID in our world, your world, my world, and what are the opportunities? Because certainly some of that rural movement, I've got a little farm in Byron Bay, and I've had so many inquiries about the value, like significant increases in value of the opportunity on that real estate in comparison to 6 months ago, where people are going, well, I need a bolt hole, I need a safe haven out of Melbourne or Sydney, and, Byron is it, or, whatever's it. Maybe the Morning Peninsula is it too, to be honest, like for you guys. So you never know. Yeah.
Personally, I saw it many, many moons ago, and that's the reason why I'm here.
Yeah.
It'll be an interesting one to watch, because that play will be very interesting over the next. I sounded like Donald Trump then, didn't I? It'll be very interesting. It'll be very interesting. So I just found this. Fuck, there it is.
There it is, the one.
Now it's not a very trusted source, right? It's just the first image that I that I Googled. The line up here. So we've got gold in blue, right? And silver in
Silver ended up more than gold. That's bullshit.
But you see what I mean? See how it lagged?
Yeah.
It lagged, and and then it just shot.
Yeah.
Right? And it's done it twice. It did it less so initially, right? So in the mid to late 90s, it did it later.
Yeah.
Right. And didn't quite, but that gold spike was unprecedented. It was like ridiculous. But you can see how it rapidly, it almost just goes straight up. It almost goes straight up. So, one of the things I was thinking about doing was just putting a little bit of a play on silver when I woke up this morning. If you believe this sort of story, I'm not telling you to invest in silver by any stretch of the imagination. That's not what I'm telling you to do. But look out for this, because if this does happen, and even if you're not an investor, if you're just an innocent bystander, so to speak, it shows you something about the psychology of markets. It really does. Because fundamentally, is there a reason why they are priced the same or at parity? But then have a look at where they end up, right? So have a look at the very last point of that chart. They both end up at 45, right? Within a couple of days of each other. But a week and a year that goes past, one's sitting at 35, 36, and the other's at 15.
There you go. Short silver, mate. Short silver. That's my call. Andy, no, I think I've cracked the code.
I might buy it until it reaches somewhere near gold, and then I'll have a crack at selling it off. But that's when the market won't repeat itself. It'll just mimic itself. It'll go, fuck you, Andy. I got you again.
Mate. Well, mate, listen, awesome to catch up with you tonight, brother. Thank you for another good wine and wisdom. Had a few good comments here. People giving us the thumbs up. Jace O'Neill reckons we should come down to Canberra because they've got fast internet. That might be true. Jace, I like Canberra. I'm a big fan. I've got my property there in Campbell, and it's doing extremely well just across the road from the ASIO building. I'm killing it. Good rents and good values, so I'm pretty happy, mate. We might touch base next time we're in town. But thanks to everyone for dialing in tonight. Appreciate everybody supporting us, and let us know. Shout out, give us a comment, bit of a chat, whatever, things you might want us to touch base on. We're always sort of, we could talk for another 2 hours, really. At the end of the day, we've got plenty to bloody talk about, but
we're only just getting warmed up.
We want to make sure it's useful and valuable to what you're up to, and add some value. So great to have everyone on tonight. Have a great weekend, gang. Andy, you too, brother. Have a good one. Always awesome to chat, mate.
Always a pleasure.
Great way to finish the week. And all right, thanks everyone. Take care. Have a good one.